Hello, I'm Lenata Wenzel. I'm going to discuss the capital gains tax question with you today. Many students seem to battle with this topic, but it's actually very easy if you know how to approach the question, and secondly, how to know what to include and to exclude. So I'm going to explain the approach to you today, but in terms of knowing what to include and exclude, you need to know your study material. So you need to go through your study material and your textbook in detail to know the theory, and that will also help you to answer the questions then. So let's look at question 3 in your tutorial letter 201 of assignment 3. Let's read the first part. It says Blue Pools has a 31 January year end, and then it tells me about a manufacturing building and a machine that was sold. So before I go on, I first want to read the required part to know where am I moving towards. It says, calculate the taxable capital gain of Blue Pools Pty Limited for the year of assessment ended on 31 January 2014. Blue Pools has an assessed capital loss of 35,000 brought forward from the previous year of assessment. So they tell me two things. I need to calculate the taxable capital gain, and they tell me about the assessed loss brought forward, and it's for 25 marks. So my first step of approaching a question like this is to look at the calculation of a capital gain. And as you will already know, a capital gain is proceeds less base cost. So the first thing that you always have to do with a capital gains tax question is calculate the adjusted proceeds. Except if we give you the adjusted proceeds in the question, then obviously you're not going to calculate it, but just use it further. But this will usually be your first step when you do a capital gains tax question. So let's read the information of the first asset, and then we'll continue to the proceeds section. So it tells me about the year end, and then it goes on. The business supplies you with the following information with regards to a manufacturing building and a manufacturing machine that was sold during the 2014 year of assessment. And then it goes on to give me information for the building and for the machine. So before we read all the information, let's first just focus on the manufacturing building, because I'm first going to calculate that separately. Then we move on to the manufacturing machine, and then we'll conclude our question at the end. So if we look at the manufacturing building, they tell me the date of purchase is 1 July 2000. That means that it's before 2001. That will impact my base cost calculation. Then the purchase price and the date of sale. Then they give me the selling price and other information. Before I actually read it, I want to show you how I approach a capital gains tax question. As I read the information, I write it down at the top, certain things that I need to know. I need to know what is the selling price. Secondly, I need to know what is the cost before 2001 and what is the cost after 2001. Other information that I might also need is the market value, the time apportionment base cost, and that's basically it. So if I read the question, in this case it was given in a table format, which is very easy, but it can also be given in a sentence format, and in the same way, as I read the question, I fill in the information as in the top part, and then I can refer to it very easily. So if we look at the information, and they tell me that the date of sale is 1 April 2013, which is in my 2014 year of assessment, so I will account for it in this year. Then they tell me the selling price is 890,000. At market value to an unconnected person. This means that I can use this value because I don't need to adjust it because it is with a connected person. So my selling price is 890,000. Following information, adjusted proceeds for CGT, they didn't provide it, I will have to calculate it. Capital allowances claimed until 31 January 2013. So this is 31 January 2013 is the end of my previous year of assessment, so they have given me the capital allowances up to that point. I just need to then go and calculate for 2014. So I'm going to put it there in my additional information, my capital allowances, and that is 48,000 up to the beginning of my 2014 year of assessment. The following line gives me the valuation on 1 October 2001. This is my market value. So I insert my market value of 88,000, and the time apportionment base cost is my following line of 90. I again insert it at the top. We will always give you the time apportionment base cost. You don't need to calculate it. You just need to know where to use it. The last line that they give me is the cost of the valuation carried out on 1 July 2003. This is, in other words, a cost relating to the asset after 2001, 4,500. So I will insert this in my cost after 2001. And that's all the information that they give me for this asset. So I can then start with my calculation, and the first step that I will do is the proceeds calculation. Now this calculation is exactly the same for all assets, whether the asset was purchased before 2001 or after 2001. So you will always use these formulas in calculating the proceeds. So it's very good for you to memorize them and to know how to calculate them, because you can get a lot of marks out of this. So your first step with proceeds is the proceeds calculation. And it is basically, the selling price less the recoupment. This gives you the adjusted proceeds, which you will use in your CGT calculation. So do you see, you can't only use just the selling price, you have to take out the recoupment. When you do a CGT question, you must always take out the recoupment and all the capital allowances. You'll see as we go on, it's very important that you always do this. So this is the first step. In order to take out the recoupment, we need to go and calculate it. And the formulas for that is that you start with the cost of the asset. And the cost of the asset is 80,000, as we've seen there, 80,000. Then we deduct all the previous allowances, all the capital allowances. And they have given us all the allowances from the purchase date of the asset up to 2013, and that is the 48,000, which I will deduct because I already know they've calculated it. But then I must remember to add my 2014 capital allowance because I have used the asset in this year, so I am entitled to claim it. And because this is a manufacturing building, I can claim a 5% allowance on it. This you must be able to know and to calculate. So how I calculate that is the cost, 80,000, times 5%, and that gives me an allowance that I will deduct of 4,000. And this calculation gives me the tax value of the asset. That is 28,000. The following step is where I say the selling price less the tax value, which I've calculated there. The selling price I have, they've given me in the question as 890, and I just slot it in. The tax value I've calculated there, so I deduct it at the bottom. And this gives me a total of 862,000. But remember that the recoupment is included in income, so I'm taxed on it, and I can't be taxed on more than I have claimed previously. So my recoupment is limited to previous allowances, which is the 52,000, which I have already calculated. So I can just slot it in there. And this means that this is my recoupment, not the 862. So now I know what my recoupment is, and I can now slot it into my top calculation, where I have my recoupment of 52 that I deduct. I know my selling price is 890,000, and this gives me the adjusted proceeds of 838,000. And this is my proceeds calculation. So there's a few formulas that you need to know, and to know how to approach them and where to use the figures, but then it's easy to calculate it. So you will have to learn this to be able to do it. So the next step is the base cost. So I just first want to show you in theory what is the base cost, and then we'll get back to the question. When you do the base cost, you have to distinguish between an asset that was purchased after 2001 and before 2001. The formulas are different. After 2001 is quite easy. It's basically all the costs of the asset less your capital allowances. Remember, you have to take out your recoupment and your capital allowances whenever you're using a CGT question. This will give you the base cost of the asset. For an asset purchased before 2001, it's totally different calculation. It's the valuation date value of the asset plus costs after 2001. And this will give you the base cost of the asset. Now in our case, we know that the asset was purchased before 2001, so we will use this calculation. Valuation date value is the paragraph 26 and 27, where what we will use to apply and calculate this value. And then you add your costs after 2001 and you're finished. So let's look at the calculation for this question. If I look at the information again, I want to show you quickly what you need to do before you go on. With the selling price, I've calculated my adjusted proceeds, remember? So I can't use the selling price anymore in any other calculations that I do. I actually have to show myself that I need to use the adjusted proceeds. So I actually physically go and replace it on my memo for myself, so that I know that I will use this in future. And the same with the cost of the asset. I've already taken out the capital allowances, so I know this is the value that I will use in future when I use the cost before 2001. So I will physically go and replace it. Sorry, it's 28,000. So this is now my new cost for before 2001 and my proceeds. So the first step when you do the valuation date value for the base cost is to determine whether the proceeds, the adjusted proceeds, remember, is higher or lower than all the costs of the asset. So this is also the adjusted costs, but the total cost. So let's do it physically for this question. My proceeds, I already know, is 838,000. So I slot it in there. You need to show us this calculation to show us how you come about the calculation of whether you're going to use paragraph 26 or 27. So indicate it in the same way to us. My total cost is my cost before 2001 plus my cost after 2001. But you see, I will use the adjusted cost, the 28,000 and not the original 80,000, because I need to take out my capital allowances. So my total cost is the 28,000 before 2001 plus the 4,500 after 2001. And this gives me a total cost of 32,500. So do you see the proceeds is more than the cost? And that is why I will use paragraph 26. And this gets a mark. You must show me that. If the proceeds were less than the total cost, you would have used paragraph 27, indicated to us, and then go on with whatever paragraph 27 implies the rules are. So if you look at paragraph 26, the rules of paragraph 26 to determine the valuation date value is, it's the greater of the following three values. The market value, which I have in the question as 88,000. The tab cost, which is 90,000. And then the 20% rule. This is the only one that you will have to calculate. And this is 20% times proceeds less costs after 2001. So it's 20% times proceeds, again my adjusted proceeds, 838, minus costs after 2001, 4,500. And this gives me a value of 166,700. So if I look at the paragraph 26, it's the greater of the three. So it's very clear that my valuation date value is the highest, the 20% rule. So there I have, there I have my valuation date value, but this is not the base cost. Remember, I have to add my costs after 2001 to get to my base cost. So I show that my base cost calculation is the valuation date value plus the costs after 2001, which is 4,500. And this gives me a total of 171,200. But then I'm still not finished. I still need to calculate the capital gain, which is my adjusted proceeds less the base cost. My adjusted proceeds I've shown you in the first page. You just pull it through to the final calculation, and my base cost is 171,200. This gives me a total capital gain for this asset of 666,800. And this is my capital gain for my manufacturing building. And that's the first calculation. That's the first asset calculated up to that point. So now I go on to the second asset, and right at the end I add them together. So let's read the second asset, what the question states and what they give us. Now we're looking at the machine. The machine was purchased in 2013. This means that it's after 2001, so I will use that formula for the base cost. The purchase price is 456,000, including VAT. So this tells me that I will have to take out the VAT out of the cost. The date of sale is 31 January 2014, which is in my year of assessment, so I will take it into account. The other value that they give me is the adjusted proceeds for CGT. So in this case, they give me the adjusted proceeds, so I don't need to go again and calculate it because they've already given it to me. You've already showed that you know how to calculate it with the first asset. The only other value that they give me is the time apportionment base cost, but if you look at the calculation for the base cost for an asset before, after 2001, there's no valuation date value, so you actually won't use the time apportionment base cost. So you can ignore that figure. And the other value is agent's commission paid on 31 January 2014, so this is after 2001 also, of 30,000. So what they give me is the cost of the asset, another cost relating to the asset, and then what I'm going to use is my adjusted proceeds. So if I go to a calculation now for the machine, my calculation is proceeds less the base cost. The proceeds they've given to me, the adjusted proceeds, are 400,000. I can slot it in there already. And the other thing that I need to now calculate is my base cost. How I do that is, remember the formula, cost, all the costs relating to the assets, less the capital allowances applicable to the asset. That gives me the base cost. So if I start with the cost of the asset, they tell me the cost of the asset is 456,000, including VAT. So I will have to do a calculation here. 456,000 times 100 over 114. And this gives me a total of 400,000. Then I have to take out my capital allowances applicable to this asset because it is a manufacturing machine and I will have been able to claim allowances on it. Now what they tell me in this question specifically, which is a hint for the rate that I'm going to use, it's a used manufacturing machine. And if you go back to your capital allowances section, you will know that a manufacturing machine is claimed over 20% for 5 years if it is used. If it's a new machine, you would have used 40%, but in this case it's 20%, and the machine was actually bought in the year of assessment. 1 July 2013 is in my 2014 year of assessment that ends on 31 January. So in this year of assessment is the first year that I would have claimed for it. It's the only year and I can claim 20%. So my capital allowance is the cost that I've calculated there, 400,000 times 20, and this gives me a capital allowance of 80,000. And this is my cost relating to my machine. And the other cost that they have given me is the agent's commission, which I can add. This is typically where you need to know which costs you can add to the base cost or not. Agent's commission is one of them. And that's all the costs relating to this asset that I can add together. So my base cost of the asset is 350,000, which I can slot there in my formula for the capital gain. And this gives me a capital gain of 50,000. And that's the final calculation for my machine. So the next step, the final step, is to calculate the taxable capital gain. So you see that this company had 2 assets that they sold during the year. I need to add them together and then calculate the taxable capital gain. So my very last step is my taxable capital gain, where I will add the capital gain of the building. And I've calculated that as 666,800, and the capital gain of the machine, we've just calculated that as 50,000, and this gives me a total or aggregate capital gain of 716,800. From this total, I need to deduct my assessed loss brought forward. There's my assessed loss, and they've given me in the question that it is 35,000. That's the amount that I will deduct there. And this gives me my net capital gain. But this is not the final step. They're asking for the taxable capital gain. That means that I need to apply my tax rate of 66.6%, and this gives me my taxable capital gain. And there I'm finished with the question. So that's the end of calculating a capital gains tax question. So do you see it's not really that difficult? If you know your formulas, if you know your theory, you know where to start and how to go through it, then it's really easy. So go and practice yourself with other capital gains tax question in your tutorial later without looking at the solution. Follow the same process and format and see whether you get to the same answer. I hope this has helped you.